Hello, everyone, and welcome back to Spicy Takes and Tax Breaks. I'm your host, Aubree Denekamp, your tax strategist and the one keeping it real with you today. So I want to talk honestly for a second about something, and it's something that when people hear the word structure, they immediately picture something that is intimidating or really hard or requiring an amount of discipline that seems impossible. But it's not. It's not lawyers, it's not binders or expensive setups always. It's complicated words that people don't understand. That is what comes to mind for them. And because of that, most people avoid it entirely and miss out. But structure isn't meant to be scary, or it doesn't have to be scary when done correctly. Structure is simply deciding where money flows before it ever hits your personal account. And that's it. Hustle is about effort. Structure, though, is about design. And people who are winning long term, they're not designing their money emotionally, they're designing it intentionally. So if you've ever looked around and thought, how are other people doing less but somehow making more? This episode is your answer, because yes, hustle does create income and revenue, but structure determines the outcome of what's going out of your pocket at the end of the day. So what does structure actually mean? This isn't the TikTok version, it is the real life version. So I want to get grounded here. When I say structure, I'm not talking about opening random LLCs, buying vehicles that you can't afford because Section 179 apparently is great, creating complexity for no actual financial gain or structure purposes, or saying something like, oh, well, I've never been audited and I don't know, my accountant probably handles that. I've never looked at it before. Those are bad things. So structure actually means deciding how the money enters to you, where it sits once it comes in, how it's paid out for other things, how it's taxed, how it's protected, and then how it's reused if possible. Most people are really asking one question, and it's the wrong question. People ask all the time, how much do I make? But people who have it all figured out already or are very well advised, they are designing it from different factors all at the same time. So it is, how is it taxed? Okay, that's how I'm going to be making money in this section. How am I going to use it? Is there a way for me to make this personal expense a deduction? Is there an asset I should be buying or money I should be investing into my retirement? There's all these different things you can be using, and one is not the way. You should be looking at all of them. And that's really the difference. I know some of you are thinking, okay, that sounds really great, but what does it actually look like on a Tuesday? So let me walk you through it, just a basic standard person, not anything through the textbook. Let's say you run a service-based business. A client pays you a $20,000 check for a job. That money does not hit your personal account because you are a business, sole proprietor, LLC, S Corp, whatever that is. So it's going into a business account. Let's call it your operating account. And by doing that, that is the number one piece of the structure. At this moment now, that $20,000 is not technically spending money, but it is data. It's data that's not necessarily going to be taxed at that $20,000 value, which is important, but what happens next is. So let's say that $20,000 sits in a operating account temporarily before expenses go out, and people think, okay, I've got this money, great. And you do, I guess, in a sense, but not exactly in a longer term plan. You receive $20,000 and that's great. But that $20,000 already has taxes on it. Some of it belongs to the IRS or to the state. Some belong to, like I said, the business expenses, and some does belong to you. But structure is what decides what percentage goes to each of those buckets or categories before that money ever hits you or your lifestyle. So how it's paid is huge. Instead of transferring whatever feels right, or whenever it's in your bank account, you try to decide in advance. You say, okay, I pay myself X per month through payroll if you're an S Corp. You are either way, whether S Corp or LLC or sole prop or whatever that is, you're creating reimbursements that happen monthly. You're updating your accountable plan at least annually, if not more. You're making sure if you do owe taxes that those estimated taxes are scheduled. Penalties can be hefty. And this is when people stop panicking about the tax time, not just because, oh, wow, I paid in advance, but you're actually structuring a plan about how to mitigate some of that. Not because you're making more money necessarily, but because you're planning before the IRS ever looks at it. So how it is taxed is just equally as important. This is where people think the magic is happening, but really it's not magic. It's math. Payroll is taxed one way, distributions are taxed one way, reimbursements are taxed one way, owner repayments are taxed one way, certain deductions reduce taxable income before tax applies. But instead of thinking whatever is left in my bank account is mine, you start thinking each dollar that I'm spending, each dollar that I'm earning has a different tax outcome depending on its job. So, same income, different treatment has different outcome and different expense to you on a tax standpoint. Some income can cost you a lot more in taxes than others. How it's protected is another big piece here. This is where the structure becomes about sleeping at night, making sure you are protected, your assets, your family, everything else is. So let's talk about like an operating company. It takes income in, it pays out all of the operating expenses and holds short-term cash, but it's not holding your long-term savings account, any of your distributions, any of your assets, investments, any excess cash. Because if something ever happens to this holding company or business, a lawsuit, an employee issue, personal dispute, even that goes legal, the risk is contained to just that holding company. It's not something that is paranoia. It is adulthood. It is protection. I highly recommend that for most structures, again, depending on what you're doing. But it's also how you're able to reuse it. This is the part where people never really reach for. Leftover money doesn't just sit there. It should be being reused intentionally, whether that is invested back in the company for growth, invested into other accounts, saved, reallocated, planned for the next year or retirement, used to acquire assets, other types of businesses. These things are huge and also very, very beneficial from a tax standpoint too. So you should stop asking, how much am I able to spend? How much do I have in my account? And start asking the question, hey, how many times can this dollar be reused or work before I have to touch it personally or have it hit a tax liability account? So putting it all together, let's say that same $20,000 entered the business, sat in the right bank account in the place, was divided intentionally, taxed efficiently, protected from unnecessary risk, and reused instead of wasted with tax liability. And at no point did we have to create 8 different shell companies, donate ourselves money, or do whatever TikTok is recommending these days. It's boring on paper, I know, but it's unbelievably powerful in real life how little of that $20,000, if any, still needs to be taxable income at the end of the day. So why hustle alone stops working after time? Income might still continue to increase. The harder you work, the more the income might continue to come in, and that's great. But risk is still increasing, taxes are increasing, pressure is increasing. That's why you see people who are making, let's say, $200,000 to start. They're stressed maybe, but $400,000, they're still stressed. $700,000, they're even more stressed a lot of times. More income with the same system is going to continue to cost you more, but also provide bigger holes and bigger issues. And the more money you make without a plan is more money you're unnecessarily giving away, which for me is such a pain point. Structure starts with intentional pay first. So most people pay themselves whenever there's money in the account, whenever random transfers make sense to them or they want to buy some new toy. There's no strategy behind it. Instead of saying, okay, what kind of income do I need to live? What kind of income can I put through my business as expenses? What am I using this income for? Income should be serving 4 purposes. It should be your living expenses, your taxes, growth potentially, and also your protection. Structure is simply separating those on purpose. You are making sure that once your money has a job, it is continuing to work that job and not continue to leak more liability holes or money. So different things, entities, they can matter so much. Structure does matter, but they can also be pointless. So an LLC by itself does nothing for taxes. Zero, nada, zilch, nothing. Entities only matter when they change something meaningful. So if income is taxed, how that money and income is flowing, how liability could be isolated, or what strategies are even available, that all depends on the entity structure. So people say, what's the actual point of having an entity then? Here is the big answer. Let's say you have a partnership. It's 50-50 partnership. Two business partners, not married, not romantically or intertwined in any of that way, familia wise. They have the same operating company, same income, same responsibilities, built it from the ground up. But they have very different personal lives. Partner A has a stay at home wife, three different children who are still dependents in the house. They are very interested in retirement planning, and they have benefits that need to be fulfilled for the entire family. They want to find a way to make income smooth, cash flow available for home, but also provide for all those saving needs. And partner B is older. They have no spouse, no kids that are in the home as dependents. They live a very different lifestyle, very, very into travel. And priorities for taxes are very different, as well as retirement saving. And the question that you often get is, why should both partners be forced in the same personal tax strategy? They share a business, so legally they have to be, but they shouldn't, and they don't have to be if you structure a little bit different. So how they structure it matters. Instead of owning the operating company directly 50-50, the operating company runs the business and earns the income, and now you have two subsidiary LLCs owned by each of the partners. So each of these partners own their own holding company, and these holding companies own 50% of the operating company. It's the same business, same economics, a little bit of paperwork that's filed to begin with, another additional Schedule C on your return, but different downstreams and definitely different flexibility in what is deductible and how much you can be taking. So this is powerful because now the income flows like this. Let's say the operating company, instead of providing distributions to each of the partners, they're providing these distributions to each of the holding companies. From there, each partner designs their own strategy. Partner A, let's say, could run payroll for their children. They could be paying their spouse. They can maximize all the retirement accounts, IRAs, 401ks, and they can structure all these different family reimbursements. Whereas partner B could be focused on keeping things lean, optimizing cash flow to be able to have bigger buying capacity for other commercial properties or projects. They can invest differently with that. They can find a way to use a lot more travel and do marketing within that capacity. They can have that same partnership, zero obligation to have the same expenses or be splitting those expenses in the same capacity or losing out completely by paying personally. But there's also no forced compromise. The structure is doing its job and both people are benefiting here. And legal protection is also huge here. The operating company is where clients live, the risk lives, lawsuits are happening typically. The holding companies, they don't serve clients or customers typically. They don't sign new contracts. They don't create liability for you. So if something happens at the operating level, the risk is contained there. Think of it like the operating company is doing the work, taking the risk on, but the holding company is owning all the valuable things and taking all the pleasure. So same money, less exposure, and long-term control is there. Another big one that I'm asked all the time, I want to slow it down here because this is one of the most misunderstood areas that I see even with clients who've worked with me for a little while. We've never delved into it together, is trusts, insurance, the concept of infinite banking, being your own bank. None of these things are a magical pill, though all are great when used correctly. So I want you to think about it like a trust being a legal container. And decide to own something, who is going to control that something, who's benefiting from that something, and when all of that happens. Trusts are often used for estate planning, asset protection, long-term wealth transfer, but they're not used to hide income like a lot of people think, and they don't necessarily eliminate taxes. They can do a lot of different things, but I want you to think outside of that for this conversation. So if someone is pitching you a trust as a tax hack, especially if it's a personal trust, is a huge, huge red flag. Here's the truth too when it comes about insurance. Wealthy people insure risk before they optimize tax. Insurance buys you time. Time to respond, time to negotiate, time to not lose everything in one event. Similar to structuring different and shifting your liability, think of it the same way here. So structure without insurance is somewhat incomplete for the most part. Again, something's different, but one of the bigger types of insurance is going to be the life insurance and becoming your own lender. I am actually a fan of how some of this can work, but I see so many people do it wrong and it's costly and so ineffective. It's Not worth it. So life insurance is not an investment replacement in most cases. It's not some sort of stock market hack, and it is for some people, but not for everyone. So if it is structured correctly, certain policies can build quite a bit of cash value, and they allow you access to that cash value. So they allow you to borrow against it without triggering any sort of tax, and you're able to pay that account back interest, which is yourself essentially. So instead of borrowing from a bank or getting a line of credit, HELOC, whatever that is, against your house, some people borrow against their own policy and you're able to repay yourself that. So life insurance is active while you're alive versus just when you're dead. It is not magic at all. It is not a wand. It is math. And it only works when you're coordinating this with some sort of real planning. So make sure definitely don't just go do this yourself. Like I said, I see it done wrong more than right. But when done correctly, it is a great strategy. And again, instead of having taxable revenue, your a lot of times passive income at that time is building for yourself and you're just borrowing from it. So there's no actual taxable income coming in, which we'll get into in a much bigger way later on. But let me be blunt. You're wasting time and money if you're hearing all these strategies or maybe implementing some of them and you're adding a lot of new expenses and money throwing at it, maybe opening new entities without a purpose. Nothing is changing financially in your tax returns. Maybe you're owing more year after year. You can't explain your setup to someone, or maybe you're just not being audited. So your tax bill should not be a surprise if you're doing any of this, because truly complexity without clarity is worse than not having a strategy at times. So as much as hustle is admirable, I so admire the heck out of a structure. Remember, without a structure, you're exhausting yourself, working harder, not smarter. And you're not going to win because you're trying harder every time. You might get further, but you're going to create more problems as you go. You can win because you have rules, you have a structure in place, but specifically you can make your money work for you before you ever have to pay on it. So keep that in mind as we get into the next episode. And if your success feels heavy instead of expansive, that's not personal failure. It is something you need to look at and absolutely something we can take control of right away. It's just a system that needs to be redesigned. So please make sure you're getting those systems in place this year, and those can always be fixed. Again, stay tuned for next episode. I'm Aubree Denekamp, the write-off queen, and this is Spicy Takes and Tax Breaks.